are live. All right. Sorry about that. A little bit late here. Had some technical difficulties, tornado watch, bad weather, but we made it. Oh, today this is the business sale readiness blueprint, where we talk about how to get your business sale ready and maximize value when you go to exit. If you didn't make it to our last session, we'll give a quick intro real quick. My name's Pete Vera. I have a background in supply chain management and logistics. It's what I did in the Navy for 8 years as a supply officer. I then became the managing partner at Green Rock Logistics, where we buy, invest, and partner with small logistics companies. I'm also the host of Exit Algorithms, where I get to interview the top minds in business and exit planning, such as Mr. Asa Patterson. Asa, you mind introducing yourself?
Yes, Asa Patterson, retired Marine Corps captain. I was in logistics and transportation, so Pete and I have a very similar background. And once I got out of the Marine Corps, just got into the entrepreneurial frame, and that led me to mergers and acquisitions. And really excited about being in this space. There's something called the silver tsunami that's talked about a lot, and it's really baby boomers. And what we focus on, the retirement bank method, is helping baby boomer business owners, say that 3 times, be ready to retire, to position their business to be able to transition it to another owner.
Yep, awesome. Exactly. Match made in heaven. So, yeah, today we'll talk specifically about financial readiness. So, if a buyer's bank they take a loan out, if they don't the bank doesn't trust your numbers, then you're not going to close the deal. You're not going to be able to sell your business. So, buyers pay for numbers they can really verify. And we'll talk specifically on some terms here. Yeah, us start off with EBITDA. The base layer here, probably the most important thing when it comes to your sale is EBITDA, earnings before interest, taxes, depreciation, and amortization. Just measures profitability. Banks use it to determine what is the business actually making, not just the P&Ls, the tax returns. They might say one thing, but the EBITDA gets to the true profitability of the business.
And when you're
Yeah, Asa, you
measuring the
want
true
to?
profitability of the business, can you hear me?
Yep.
Okay. When you're measuring the true profitability of the business, that's when you're looking at the annual revenue, right? EBITDA. Am I okay or am I glitching? I'm glitching on
You're
my end.
good.
I'm
You're
okay?
good.
All right. So you look at the annual revenue, and businesses are sold based on the annual revenue. So if a business has an EBITDA of $1 million, then depending on what niche that business is in, it will sell between two, three, four, five, 6 times the annual revenue based on what Pete was saying, how the numbers come out. If the bank and the buyer trust the numbers, if they're clean and they're presentable, that allows the seller to have a higher multiple when you're looking at EBITDA.
Exactly. Yep. You hit the nail on the head there, and that leads to our next term. Add backs. So that's really important to know the perspective of the buyer, right? We want to the buyers and the bank they use to take a loan to buy your business. They're gonna try to get that to that number, like Asa was saying, the exact profits of the business. So add backs are personal expenses or one-off business expenses that the new owner won't have when they buy the business. So whether that's your personal vehicle, your wife's Pilates membership, whatever it is, any expense that you're running through the business that doesn't actually generate revenue, or that the new owner won't be having, that is an add back. So that'll count towards your profits, and it results in a more accurate picture of your business.
And one of the reasons why we're talking about EBITDA and then going to ad backs, because ad backs are really the expenses that the new buyer is not expected to continue, right? So, like Pete said, those expenses are, car notes, vacations, anything is. Because what we're finding is that most businesses are lifestyle businesses. They're really family businesses that kind of grew, and now they have something that becomes an asset that they're looking to sell. So add backs are very important to understand as a buyer, as well as when you're the sellers, to be clear on the numbers that are included in your personal lifestyle with the business that the new buyer is not going to take on, because those numbers actually go into the EBITDA to help you when it comes to selling the business.
Yes, yeah, exactly right. And so most buyers, especially small businesses under 1.5 million EBITDA, they're going to take a loan out to buy the business. So it really comes down to what the bank will give a loan on. The bank will look at the EBITDA, the profits of the business, and decide whether the new buyer will be able to pay the loan off using the profits of the business. That's when the debt service coverage ratio comes into play. So the more accurately you can show your financials and prove that it's making the profits, the easier it's going to be when you go for your buyer to go and get a loan, and ultimately, it'll add value to your business because you'll be able to demand a higher EBITDA multiple. The sale will be a lot smoother. Yeah,
So
and that.
you said something I want to clarify, Pete. Debt service cost ratio, right? Some owners may not know that, but we want to make sure that we talk about that just really quick. And that's whether the business generates enough cash flow in order to make the payments, because it may be a debt-free business to the current owner, but the new buyer is going to have to borrow money to pay for the business. So when it comes to DSCR, excuse me, can you go a little bit more so that they have a clear understanding of what the can't turn this off. Okay, excuse me. So what does the DSCR mean? Am I
Yeah.
there?
Yep, you're good. Yep. All
So
good.
DSCR is, for example, we talked about this earlier, Pete. If a business has $100,000 a month in revenue, right? The DSCR, typically the banks will go at 1.3. What that means is you need one and then a third. I don't know how to explain that in order to make the payment. So a DSCR of 1.3 would mean $130,000 a month in revenue for the business, which would equal a DSCR of 1.3. Right? If it's a 1.0, it becomes very challenging for the bank to fund a business like that. They may require a reduction in the sales price, or the buyer to have a hefty cash reserves in order to make the payments in case something happens in the market.
Yeah.
You want to add to that, Pete?
Exactly right. Yeah. I'll just say, especially small businesses, the most likely loan source is an SBA loan. And that's a loan amortized over 10 years between 9 and 10.5% interest rate. You can use math, and it's simple math to calculate how much you'll be able to afford with debt service. So the maximum most buyers are going to be able to pay is around 4.5. That would be a good quality business with clean financials. So it's important, from a buyer's perspective, they may want to pay more, but they simply won't be able to, not because they don't value your business, but because they won't be able to get a loan that can support the debt service. So
And
that's
that's
the
important, Pete. I want to add on to that because it's just simple math. When you look at a business, you see what they're asking, you do a quick math for the DSCR, and then you see if the bank will fund that kind of deal. Like you just said, there are limits on the max of the multiple that a bank will allow. So a seller must understand that, because if the seller thinks the business is worth more than the actual bank will fund, then the deal will never get across the finish line. So it's just so important to understand the numbers. That's why we're coming to kind of give you a layman's term breakdown of the numbers so that you can kind of start having a understanding of what your business is actually worth based on the numbers, on the math, on the money, the revenue that's generated on a monthly basis, and then you can price the business accordingly.
Yep. Yeah, exactly. Begin with the end in mind. Who's going to be your buyer, and
Right.
yeah, realize the constraints therein. That leads us to our next term is accrual counting. If you're you might already know this just by being a business owner, but it's important to know about accrual counting is that banks want to see that. They want to see the true, no, the truest profits per month. So it's popular. A lot of businesses we talk to, they'll do cash-based accounting because it can be beneficial at the end of the year. Say you're in December, it's the end of the tax year. If you do cash-based accounting, then you can take off the accounts receivable that are incoming. So basically, you'll show less revenues for that month, and then ultimately pay less money to the IRS. So it's a nice tax strategy, but when you go up to sell, that can become an issue. So just keep that in mind and work with your accountant or CFO, whoever it is, to recast your financials to be accrual accounting. That's going to add value.
And why doing that helps reduce and eliminate the red flags, the messy books that lower the offers or even stall the sale. So we're just sharing this information with you business owners so that you can have a better idea or a stronger understanding of what you're going to face as you move toward getting the business ready for sale. I just want to reiterate that if you have a friend or family member that's a business owner, you come across this, please share this with them because it's important. The more you understand the process, the less emotion and uncertainty that you'll have as you move through the sale process.
Exactly right. Yeah, certainty. Buyers pay for certainty. Yeah, let's do a quick example, quick thought experiment. Business A and business B, right? Business A, they have very clean books. They've been working with their accountant. They know they're going to sell their business in a few years, so they have 3 years of solid, clean financials, well documented P&Ls and tax returns. They say that they're on the same page. There's nothing to explain. They give you them, the same day you ask for them. Now, business B, not so much. They decide they're going to sell tomorrow. They've been doing some tax, get gymnastics, and their tax returns might say, oh, they're making 100,000, but in reality they're making close to 1 million in EBITDA. But they can't prove it. They know that they've been putting their personal expenses on there and running all kinds of things through their business to bring down the profits on paper, but they can't show you. So you're just going by their word of mouth. Which one is more trustworthy, or is likely a bank is going to give money to buy that business?
I'll take door A, right? Because it has, you can look at the EBITDA, it's accrual counting, the add backs are clean, so the red flags are minimal. I want that business. I want to underwrite that business. I want to look at buying that business versus the one that the profit and loss statement doesn't match up with the tax returns and things are very questionable. So give me the first one, Pete.
Yes, sir. Yeah, I think any buyer would say that, right? Yeah, it's pretty common sense, but you just got to think of these things well in advance of the actual business sale. And that's just what this is. This little graph here, just showing what we just talked about. That the more confidence the buyer and the bank has that the revenue, the business profits will continue post close, the more money you're going to be able to demand at the closing table. So,
And it's important. You see here, those things reduce your value. But we just want to talk real quick and share this information with you guys. If you have a friend, a family member, or if you are the business owner, some of these things you may want to start taking into account because as you get closer toward the golden years of retirement age, you may want to start putting these things in place before you talk to a broker, before you start putting the business out in the market. If you are viewing here on your computer and you can scan, we just have a quick QR code where you can give us your email address and we can send you a recording of this. You may not been able to take it, write any notes. You may be driving, and we're also going to give you a checklist. But this is just something that we want to provide to you guys to give you a better understanding of how to maximize your business and your retirement.
Yes, sir. Yep, short and sweet, like we promised, under 20 minutes. And so next week, or actually probably in two or so weeks, will be module 3. We'll talk about operations and systems, how to design your business so that it runs basically without you, and how that really increases the value of your business. So, thank you, Asa.
All right. Appreciate your time, Pete.
Attending. All of our audience,
Yeah.
I saw a couple. All right, I'll see you next time.
All right.